Excellent question. Predicting specific price movements for 2026 is impossible, but we can analyze the key catalysts and risks that financial experts are already monitoring for that period. Here's a breakdown of the consensus themes and debates for stocks and gold in 2026. The broader context for 2026. 2026 is seen by many strategists as a potential normalization or inflection point year, following the volatile post-pandemic and high inflation period. The outcomes of the 2024 US elections will have set policy directions that will be impacting the economy by then. Outlook for stocks in 2026. Experts are focused on a potential shift from macro-driven markets to micro-driven ones. Key watch points include bullish catalysts. 1. AI productivity and earnings. By 2026, the massive investments in AI infrastructure, 2024-2025, are expected to start translating into measurable productivity gains and earnings growth across sectors beyond just tech. Experts will watch for margin expansion and new revenue streams. 2. Interest rate trajectory. The consensus is that the Federal Reserve will be in a steady rate or even rate cutting cycle by 2026. The pace and timing of cuts will be critical. A soft landing scenario, controlled inflation, steady growth, is considered ideal for stocks. 3. Corporate health. Balance sheets are generally strong. Experts are watching for sustained capital expenditure, CapEx, cycles, particularly in tech, energy transition, and onshoring, reshoring initiatives. 4. Sector rotation. If rates are lower, sectors like small caps, financials, and real estate, which are sensitive to borrowing costs, could see a resurgence, potentially broadening the market rally beyond the current, Magnificent Seven, mega caps. Key risks and headwinds. 1. Valuation stretch. Stock market valuations are historically high. By 2026, companies will need to deliver exceptional earnings to justify these prices. Any disappointment could lead to significant corrections. 2. Economic slowdown lag. The full impact of 2022-2023 rate hikes may still be filtering through the economy by 2026, potentially slowing growth more than expected. 3. Geopolitical and election fallout. The geopolitical landscape, e.g., US-China relations, conflicts, and the specific policies of the post-2024 US administration, tax, regulation, trade, will create winners and losers. 4. Long and variable lags. This classic economic phrase means monetary policy impacts can appear unexpectedly years later. This is the single biggest unknown experts are watching. Expert consensus watch list. Earnings growth, not multiples expansion, labor market resilience, productivity data, and the shape of the yield curve. Outlook for gold in 2026. Gold's role as a hedge and alternative asset will be tested. Its performance is less about growth and more about stability and fear. Bullish catalysts. 1. Central bank demand. This has been a structural support for gold. Experts are closely watching whether major central banks, especially in China, India, and emerging markets, continue their multi-year trend of diversifying reserves away from the US dollar. This is a top-tier factor for 2026. 2. Potential US dollar weakness. If the Fed is cutting rates while other central banks hold steady, the dollar could weaken. Gold, priced in USD, typically becomes cheaper for international buyers, boosting demand. 3. Geopolitical and systemic risks. Gold remains the ultimate crisis hedge. Any escalation in global conflicts, trade wars, or unexpected financial instability, e.g., commercial real estate debt crises, would trigger safe haven flows. 4. Inflation persistence. If inflation proves stickier than expected and remains above central bank targets, gold will be sought as a real asset store of value, especially if real interest rates, yields minus inflation, stay low or negative. Key risks and headwinds. 1. Higher for longer, real rates. If the Fed maintains high real interest rates, nominal rates above inflation, the opportunity cost of holding non-yielding gold increases, making it less attractive. This is the number one headwind experts monitor. 2. Strong US dollar and robust economy. A resilient US economy and a strong dollar would dampen gold's appeal. 3. Reduced retail demand. High prices could dampen physical demand from key markets like India and China for jewelry and bars, coins. Expert consensus watchlist. Real U.S. Treasury yields, TIPS yields, central bank buying reports, via the IMF and World Gold Council, US Dollar Index, DXY, and global geopolitical stress indices. The interplay, stocks versus gold in 2026. Risk on scenario, soft landing, a Goldilocks economy, steady growth, moderate inflation, controlled rate cuts, would likely favor stocks over gold. Capital flows toward risk assets for growth. Risk of scenario, recession or shock, an economic downturn, a major geopolitical event, or a financial crisis would see gold outperform as a safe haven, while stocks could correct significantly. Stagflation scare. A worst-case mix of stagnant growth and rising inflation would be complex. Stocks would suffer due to poor earnings and high rates, but gold could shine as it did in the 1970s, acting as an inflation hedge. Bottom line from the experts. For 2026, experts are preparing for a transitionary period. The watchwords are confirmation and divergence. They need to confirm that the AI investment thesis is translating into broad corporate profits. They need to confirm that inflation is durably tamed, allowing for stable monetary policy. They will watch for divergence in performance between regions, US versus international stocks, and asset classes, stocks versus bonds versus gold. In summary, the path for 2026 is being set today. For stocks, the narrative must shift from AI hype to AI profits. For gold, the battle will be between a potential dovish Fed, bullish, and the persistent appeal of high real yields, bearish. The experts are glued to the data on earnings, central bank policies, and the tenuous balance of the global economy.